everybody. Welcome to the show. I'm Don, and this is the Talking Real Money Financial Physics Money Monday edition of the show. And, of course, we're accompanied now by artificial intelligence music. And for all of you musicians who hate it, hey, get over it. We would have never hired a musician to do this.
Wait, I would assume that you had the Talking Real Money singers in the back of the Don McDonald
Money
studio
singers,
there.
yeah.
Oh, okay. That's good to point out.
Well, think about it for a minute. I mean, the theme song, our regular theme song, the theme music,
yes,
that was from a royalty-free library of music.
So I thought it was Captain.
So it's not like I've been paying anybody much money for these things ever. Because if we had to pay for these, the music you'd get would be me humming. There you go. That's
just
all
bypass
you
that
get
if
because
possible.
we're a low-budget show. A low-budget show, but big money topics, big money topics. And today we dive back into the Book of Financial Physics, written by Don McDonald. The good book.
Yes,
and as promised, we're going to do one rule of financial physics a week until we run out of book. Which I don't.
Yeah.
How many chapters are there in the good book?
I don't know. I'd have to check.
You've got it in front of you
right now. I know. I'm going to find out right now.
20.
There's a bunch of questions too, which I refuse to take.
Yeah, no, we don't want to do the quiz.
Last word, does that count as a chapter?
No, it's not a chapter.
Rule 18.
18.
So we have,
18. So we got 14 more.
Yeah.
Well, that'll carry us through the end of 2026, pretty much. September, October.
The end of my career, right there. Very close.
Yeah, that'll pretty much seal your career forever. All right, so, ladies and gentlemen, without further ado, before we get to the Q&A part of the program, we begin with Chapter 4 from the Book of Financial Physics. Tom.
Everything eventually rises.
Okay, now, that sounds like... I know it's a little misleading.
Enron's not
because
rising.
everything doesn't.
No.
What that means is in aggregate. That's the royal everything. That's including the whole planet. Basically, the value of human economies has, at least until now, this could be the end, but I don't think so, has become more valuable over time.
Yeah, but when I read it, and I read it a couple of times because I'm a history guy, and the numbers are absolutely fascinating, but I thought, how is this relevant to me as an investor? And you, as the author, could easily tell us that.
I could.
Why does it matter?
Because, that's a great question, Tom. Thanks for asking.
Thank you. That's always bad when they say that.
I know.
You're screwed.
In an interview. That is a great question.
Yeah, there's trouble when they do that.
Yeah. You notice they always use those in the promos, too. I noticed on NPR, they have an interview show, and so that is a great question. Boy, never heard that question. Yeah, right. It's on paper.
Yeah.
Anyway, the reason is expectations. You can, if you invest broadly, have a reasonable expectation of eventually making money because when you invest in equities, that's the only thing we're talking about right now, equity securities. When you invest in stocks, you're investing in an ownership portion of a business.
Stop you right there.
Okay,
stop
yes.
you right there because I think that's a very important
I'm going to back away
to
from
say.
the mic.
Over and over again, because I think people generally view the stock market as a gambling place.
Yeah, it's a casino.
It's a casino. And this is how they should be looking at it. That's what I was hoping you'd answer it this way. Because you're investing in thousands of companies.
Well, I wasn't there yet. When you buy the market, you are buying the global economy. If you do it right, you're not just buying a few businesses. You're buying the total output, productive output, economic output of the entire species of peoples out there.
And you entitled this the macroeconomic gravity.
Yeah, it goes up. And if you look back, by the way, there have been actual studies done where academics have tried to go back thousands of years and using the records that they can find, which of course are limited, piece together the value of the global economy, basically starting about 2,000 years ago. little over
Yeah.
2,000
Oh, in
years
this
ago.
case, I think in the United States, you go back to 1790 in terms of output, goods and services per capita, per person. In 1790, which is a year that only, I think on this show, only you can remember, was $48 a year. $48
a
a
year
person.
per person. Yeah.
In
And of course,
$2010.
yeah, you got it. That's the thing.
Yeah.
That's in $2010 when I wrote this book.
Inflation.
$2010. So that's adjusted for inflation.
Yep.
Do you know anybody in the United States whose earnings are $48 a year?
I hope not.
Yeah.
But go to 1990. Wow, this is shock. These numbers are shocking if you really let it settle. That $48 has grown to $23,000, not through inflation, through creativity, through increases in productivity, through companies just doing things better.
And that was 40 years ago.
Basically, yeah.
Yeah.
And then you get to 2021. That $23,000 is now $69,231. Again, companies basically, human output is just more efficient than it was, way more than it was in that case 30 years earlier, or going back a couple hundred years. Just incredible growth. And again, investing your money in those companies, and that is, by the way, that 2021 number does not include AI, because imagine what that's going to make things look like in 4 or 5 years, you think, right? That the output per person is going to be even greater. But that's why you're exposing your money to these companies. It's not a casino. It's exposure to the growth of, as you said, the world economy.
2025, annual GDP per capita. Ready? What did you say it was in 2021?
$69,231.
This is how rapidly our productivity is and our economy is growing. The average U.S. GDP per person at the end of 2025 for the entire calendar year, $90,000.
Which is weird because I checked yours. It's 23,000.
I know. I'm an aberration.
How you did that, but that's
good. According to the Federal Reserve.
What was it again? How much?
$90,000.
That's a $20,000.
That's in 5 years.
2021. That's nuts. That really is. And then
but what's the message though?
Too.
What's the message behind all this?
What I just said. You want to make sure your money and you don't have to do anything.
Right.
All you can do is expose it to all those companies. They're going to be the ones that do the heavy lifting. They're going to increase productivity. They're coming up with ways to make things more efficient. And you're just letting them expose their stock. You're exposing their money to the growth of those firms. You also mentioned globally steady growth over 2,000 years. But 1970, the global output was about 20 trillion. Today, I in the book at least, you said 110. So 20 trillion to 110 trillion. Right. So, and growth it's not the only element in increasing stock prices, but it's a major one, right? Of course it is, because people are going to pay more for the greater output of those firms.
Yeah, and here's the thing. You mentioned it. The AI is going to add to that dramatically. What did I say it was back in 2000 and probably 21? Global GDP?
Well, in 2021, the global was 110 trillion.
Okay, so it's still about that. It's 120 trillion. According to the World Bank.
10 trillion on 110.
I guess we're talking real money. I read an interesting thing in my many papers that I read, and I think this was a proposal, and don't make funny noises, by Mark Cuban, to save Social Security. Speaking of
I read it.
AI.
Yeah, it was on my Apple News feed.
It's 50 cents per 25 million tokens of AI could basically put billions of dollars into Social Security. Just having a little tiny AI token tax, which may be necessary. I hadn't even thought of this because human output is likely to go down while AI output is likely to go up. The number of humans working and paying into the system may go down. So, I don't know. Interesting.
I think it was in the same article. There was somebody, or maybe a similar one, that was talking about means testing for Social Security, which I think it'd be a hard sell because people are going to say, wait, I put all that money in, and the fact that I did well otherwise should mean that I get less.
Then basically that says
harder.
It was a tax. See, that says it was a
right,
tax.
Exactly. Yeah, it's
and
tougher,
a tax is a hard sell. Social Security was not a hard sell.
Yeah.
But anyway, we were talking about investing. Buying the global economy is the way to participate. Go ahead.
Exactly. Well, and we don't, I mean, the other part of all that is while the United States has had tremendous increases in productivity, especially over this last 100 years, we don't know which country will be at the fore of that for the next 100. It might be here. It might not. And that's why you're exposing that money to all other parts. And we've seen in the last year, emerging markets has been the place that's grown most quickly in terms of stock prices because everybody wants to buy chips and not the type that have made me look the way I do. But I mean, the fact of the matter is that's why you're exposed to all these things all the time, right? This is something we talk about, and I'm going to talk about it to our clients here in a couple of weeks too, because I've been cogitating on that. That you just have to
do it. You gave me an idea. Maybe we should start the Idaho Tater ETF.
I bet it exists.
You can invest in chips.
I'll bet you can invest in potato chips. I bet you can.
Oh, come on.
Wasn't that what's his name had the potato chip index? He said that when the sales of potato chips go down, the economy is going to. Who was that guy? He's out of the Bay Area. He's written 100 books. He's wrong.
I don't think anybody's done a potato ETF.
Okay. There was a potato chip index, however, or something similar. But
yeah, I mean, there are commodities, but
okay, not potatoes directly. So okay, maybe Mr. Potato Head needs to come along and start that one.
Yeah. That would actually I would probably use for my ticker symbol TOTS. For my potato ETF. Good. Yeah, TOTS.
That's really good.
TOTS.
Great rule. And next time we're moving on to Rule 5, which is...
Oh, you're going to tease the next rule.
Go
ahead.
It must have been looking at my career. Worst case scenario.
How bad can it get? How low can you go?
Pretty low. Trust me.
All right. Well, now we go to the portion of the program that you sit through this other garbage to get to. This is the part you really like.
So we don't have a jingle for the opening of the question part? Kind of sad. You haven't been doing your legwork here.
Wait. Is that your wish? Rub the lamp.
That's a challenge to you.
And now, ladies and gentlemen,
the Talking Real Money Singers are back.
Straight off the page, Tom reads them out loud. Your questions, his answers right now.
You got your jingle.
Okay,
happy? Are you happy now? Are you happy?
I'm always happy now. I'm overjoyed. From Appomattox, Virginia, Kenneth writes, Don and Tom, by listening to and other people that you respect, I've learned that portfolios can be aggressive or conservative based on their equity to bond ratio.
Okay, that's really one of the ways, but that's really the primary way. Yeah.
Yep. Sure. You also speak about being aggressive or conservative based on large cap to small cap ratios. I think both of those statements are right on. Yeah. True. I am looking to set up a conservative portfolio in a taxable account that would be an ultra low percentage of my emergency fund.
So emergency money in your cash account, in your taxable account. Got it. Okay.
He says, yes, I said emergency fund. I know emergency fund.
Well, he said conservative too, right? He said conservative. Yeah. I heard that word.
We'll wait till you hear the numbers.
All right.
You'll be surprised. He says, I know emergency fund money should be in stable assets that can be easily obtained. My wife and I currently have 3.5 months of emergency funds that could sustain us if we both lose our jobs. Money is in high yield savings and no penalty CDs. These funds, he says, would not be effective. The money to start this new taxable fund would come from our general savings and would equal 1/24 of the existing emergency fund. How he arrives at 1/24, I do not know. Why am I considering this option?
Because I can't turn my brain off. I'm overthinking everything.
You got too much time. You could come over and do my lawn or something. Number one, inflation is on the rise. It seems that banks are waiting as long as possible to bump up interest rates.
Okay, hold on. Okay, one. We got two problem statements there. Interest rates are, inflation are on the rise?
Yeah, no, it has. Past tense.
Yeah.
By the way, there was a piece in the Wall Street Journal yesterday. You know how much food prices have gone up since 2019?
I don't know.
33%.
Okay.
In the 6 years prior to that, they went up 7%.
Good
so
thing
it's
I'm
quite
eating
shocking.
less.
Yeah.
And the other problem is that banks don't sit around and wait to raise the rates on savings. They're reacting to, do they need money to lend to somebody? And how much do you need to pay? What's the least amount you can pay somebody to get money from them to lend to somebody else? It is a system of supply and demand. Ooh, like financial physics last week. It's supply and demand for money. That's all
now,
it is.
When you raise this,
there's no cabal.
When you raise this, you're going to make me ask you, Don, what Bank of America is currently paying on their savings accounts? Is it still 0.01? Anyway, you chest that while I go through the rest of the question. Interest earned from various taxable accounts along with our wage increases will increase my tax situation within a year or two. I don't understand that statement. Increase my tax situation.
I don't either.
What am I thinking? He says 40% VT, that's the Vanguard Total World Fund, 35% AVGE, that's the Avantis Global Equity Fund, and 25% AVGV. Those are all stocks, by the way. So, I mean, and frankly, this is a bit overkill to have VT, AVGV, and AVGV.
And that's not even the worst of it. Emergency money, okay? You put it in stock funds. That portion of the money that is in equities could go down a lot.
Yeah.
And here's the thing. Generally, when the market goes down a lot, it's when there's some sort of an economic downturn that affects millions and millions of people, including those who go, oh, I lost my job. I really need my emergency money right now. And right now is when everybody, pardon me, I've got a little frog going there. Right now is when everybody else is trying to take out their money at the same time.
Sound familiar? Yeah. Mm-hmm.
Which causes the values to fall, which causes you to have less money for your emergency. This is not a good idea. This is not where emergency money could be. And by the way, Bank of America's rate is still it's hanging in at 0.01% APY. So with 100,000, let's go for $1 million. Put $1 million in your account. You get $100 every year.
Yeah. And there's probably $12 trillion in those accounts, something like that. That's making. There's always trillions of dollars that are so inefficiently. Anyway, okay. So no, we don't ascribe to your idea, Kenneth. But
no, but thanks for sharing.
1/24 of your account. Okay, I mean,
and it goes back to my theory. Yeah. We have these big brains, and sometimes apparently they're afraid of atrophying, and so they just sit around and go, "Well, let's do this silly thing." It happens to me all the time. All the time. It's like,
well, you've got a very large brain.
Oh, new idea. Oh, no, bad idea.
If you're really looking for things to do, yes, the lawn I can handle, but the garage I could need help on. All right, Peter from Olympia,
Washington. Don't even look at mine. Let's see. Bank of America does. I'll tell you about how much they hold in total deposits. This doesn't tell you interest bearing.
Yeah,
but they have about $2 trillion in deposits.
Okay,
some of that is zero interest bearing.
Yeah, no, I was speaking globally. All the banks.
I just thought you were talking
always
B of
have
A.
like $12 trillion just sitting around doing nothing.
Roughly about a quarter of a trillion is in what they call time savings accounts. So we don't know though.
Does that mean you can't get your money till 10 o'clock in the morning or something?
I don't know what
that means. So, all right.
I don't know.
As I said, Peter from Olympia writes, you may want to share this creative idea with your listeners.
Oh, somebody overthinking it sounds like again.
Has expressed concerns regarding the tax implications of his RMD. That's required minimum distribution.
Let's see. It sounds like the tax tail's about to wag that poor dog again.
I don't know. This is
okay.
His mother has shared her interest in a small charitable organization. When she passed away, there's an inherited IRA. She left him $1 million. He qualifies for QCDs. Well, anybody qualifies for QCDs.
Qualified charitable distribution.
Reducing the IRA by donating $100,000 a year to that charity. I found this to be an elegant solution.
Yes.
Yeah.
If you want to give away the money. Yes. Yeah. I'm just curious, though, if Mom wanted to give it to the charity, why didn't she just give it to the charity?
It's a really good idea.
Make you do it.
Maybe she wanted to see if her kid going to hang in there. Because Grover from Nashville, Tennessee, where we will be in a couple months, I will be.
I won't be.
Says, my wife has inherited an IRA, has been taking RMDs as required. She's been taking about $10,000 a year to zero it out within the 10-year window, right? You got to take out the money out in an inherited IRA in 10 years.
Right.
Once she's reached 70 and a half, she began making QCDs to the church. This is being done through a checking account set up. Every January, she moves $3,000 to the RMD. Each month, she writes $250 check to the church. This seems quite simple. Thoughts? Yeah, sure.
Okay.
Why not? You can do that from a regular IRA. You can do that. I think they're talking about changing the rules to allow you to do it from your 401k as well.
All right. So,
I think it makes sense.
If you're feeling charitable, great.
There you go. Give it away. That's fine.
Okay.
From Layton, Utah, Todd writes, you've mentioned several times on your podcast you don't invest in bonds for the return, but for the stability. If that's the case, why do you recommend BND over less volatile and more stable U.S. Treasury ETFs like VTIP, which I imagine is the Vanguard TIPS fund, or an ultra short bond fund like JPST, which I'm not familiar with? Both have beat the return of over BND over almost lookalike periods for the last 10 years with less risk. Morningstar gives BND a risk score.
Short-term thinking. That's short-term, 10 years.
Morningstar gives BND a risk score of 15, while VTIP has a risk score of 9.
Of course.
And JPST, which please look that up, has a risk score of 2.
Okay. JP Morgan, ultra short-term. That's JPST.
Okay. Yeah. Which probably holds what? I mean, what kind of paper does it have?
Hold on. I'm going to look. I'm pulling up.
While you're doing that, I can tell you right now, just so we know, BND is a cross-section of debt in America, basically, right? It's got some corporate debt in it. It's got a bunch of government debt in it. It has, a variation of maturities in it, short and intermediate primarily. So, yes, it would be, in the parlance of people, riskier than just short-term paper. And the difference there between that and the VTIP, which is the Vanguard TIPS fund, which are government securities issued and then remarked, if you will, every 6 months for unexpected inflation. They're very different funds.
Here's the rub. This is what it boils down to that for some reason gets missed. By the way, we're not saying don't buy bond funds for yield. No, you want the yield too. And what we would like is for the yield, in addition to the price to be, it's a trade-off. We want the price to be relatively stable, and we want the yield to be relatively stable. That's the problem. BND's yield over a long period of time is going to remain a little bit more stable than JPST's because JPST has an effective duration of less than a year, whereas BND's is like 6.
I was going to say 6 or 7. Yeah.
Yeah.
Sure.
So here's the deal. And let's just make it real simple. Let's say right now, what does the JP Morgan yield?
I'll bet it's still in the 3s because short-term paper is still paying pretty well.
JPST, the current yield, I don't know why it's not on this page here where it's supposed to be. For some reason it's not there anymore. Okay, let's see. 30-day SEC, 4%, right where intermediate term bonds are. Right, everything is at 4 right now.
It is. It's kind of weird, but that's
let's
where
say given the current interest rate climate, the short-term bond fund looks like a much better deal. It really does. Oh, great.
Yep.
I can get 4% and a lot less volatility. Sounds great on paper, doesn't it? Let's just make a crazy assumption, because you know this will never happen, that rates drop to near zero. What? You mean, what? Wait, rates dropped to near zero in the past?
That was like 5 years ago. Yes, sir.
Oh, okay. Yeah. So back when rates were near zero, guess what an ultra short bond fund yielded? Near zero.
Yeah.
Because they had no longer term bonds to maintain the yield at a slightly higher level. What did they not do? When rates went up, they did not plummet in price. That's why the performance difference. So if you don't mind your yield potentially going to zero, then yeah, let's go with the ultra short. I mind that. That's why I have a mix of short-term high-yield savings, or the JP Morgan ultra short, essentially, same kind of thing. A ladder of CDs, 5-year ladder, and BND. Why do I have all of those? To try to cover all of those various bases. I've got more stability with the high-yield savings. I've got stability with the CDs. I've got more volatility with BND, but I've got the staying power of a potentially higher rate. Everything
but we're not buying
trade-off.
Any of those specifically for the yield. The yield is a product of owning those securities.
Right.
What we're looking for there is stability, ballast for when things get bad with stocks, which
and again,
anytime.
Back to the same old story when you have a radio show or a podcast or any mass media, you got to paint broadly.
Yeah. All right. We got time for one more. We'll throw it in here. Salt Lake City, Utah. Doug, I'm getting ready to retire. That's awesome. I've tried to create income streams from bond interest, dividends, and treasury notes from my investments, but I think now I see the wisdom of just planning on taking money from my investments and living on that. That would be a total return strategy.
Return strategy.
Which was what we favor. I ran the numbers. Seems like if I go with a 60-40, 60% in stocks, 40% in bonds, and take from the stock fund if it does well, and take from the bond fund if stocks don't do well in a given year, and rebalance to the 60-40 at the end of the year, I'd move the money to my checking account, living on that for the year. It seems like I can get an additional 2% if I invested in preferred stock instead of a bond ETF. What's your take on preferred stock as an investment in retirement?
You could probably get an additional 2 or 3% potential return if you invested 100% in stocks, too. It's a different beast.
You would have, historically.
It's a different beast entirely. Preferred stocks are not bond safe. They are nowhere near bond safe. They're more like stock risky, but not as risky as common stock. So they're in between. So yes, you could get a higher yield. Do you understand why you could get a higher yield?
A higher risk.
There you go.
Yeah,
this is
trade-off.
Just so simple. It's all a series of trade-offs. Oh, yeah, I could make more money buying. I would have made a whole lot more money, or if I like to speak in present tense like everybody does, I'd be making more money right now if all my money was in chip companies and Apple and Nvidia.
South Korea.
I would
Taiwan.
be. Oh my gosh, I could have a much, much better retirement when I get there, assuming they all stay high. But what if they don't?
No.
That's what you have to plan for. Is the what if they don't?
Going back to the previous question, because this answers it. Bonds, keeping money. Stocks, making money. Preferred stocks are stocks. Don't intermingle them with your bonds.
Stocks is stocks.
Stocks is stocks. Do you have a jingle that says that too?
Oh my gosh! Thank God you don't know how to do. Thank God you do not know how to do this. You would be like a mad scientist who's like, oh, let's see what else I can have them sing. Although that's kind of what I'm doing right now. I'm trying to decide. Maybe you can help me out. You know the old song, this one. Yeah, that's that one. You know, where it's just we've been playing that same song now for
which I like
15
long time.
years. You are such a creature of habit.
Indeed.
I, on the other hand, am having a really good time with jingles, and I think they're kind of fun and different. Do we care about the theme? I don't know. I don't know.
I don't know. I got to think that through. I would love a 70s type of jingle, Tom and Don talking real money.
Oh, dude, you haven't listened to the latest episodes yet, apparently.
Oh, okay. I apparently
no,
not. So.
You haven't listened to the latest episodes, apparently.
I got apparently.
You haven't listened.
Uh-huh. Oh, that's going to get, the mail's going to come.
What do you think I've been doing all week? Uh-huh.
I'll look forward to that. So.
I mean, Friday's Q&A was sort of a Queen thing.
Gosh, I don't know that I may have missed Fridays because I was out messing around Friday afternoon. Didn't have the grandkids. So anyway.
Well, it was a couple of days ago. You've been busy.
Okay.
All right. So anyway, if you have questions, send them in. Send your questions in to talkingrealmoney.com. And if you type them, Tom will read them. If you speak them, they go on the Friday Q&A podcast. And if you need more help, no cost, no obligation. I should turn this into a musical bit too.
I can hear another jingle.
And go to talkingrealmoney.com and click on Meet an Advisor. You can meet with one of our Appella advisors for free for nothing with no cost, no obligation. And let me make a promise that we've been keeping.
Can I add one thing here? Can we put all the jingles on one button on the website, and people just listen to the jingles? Put them all up there. A jingle package.
I could technically do that.
Just curious.
I could. We could have
do we know how the
Real
lawyers
Money
feel about all that yet?
They don't care about music. There are no financial claims in the music portion of the program.
Okay.
They don't care.
Guaranteed 100%.
He did it again. Okay.
Wait till the words start going ding, 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 ding.
Okay. A message for the compliance people or the compliance AI.
That was not me. That was the jingle people.
No, Tom does this once in a while. It's humor.
Testing.
Okay.
Testing.
It's his version of humor. So we humor him along the way. So please don't call him on it like you did when he once said guarantee. He didn't really mean it. Thanks for listening. Before he says anything else, we've got to go because we're
Talking Real Money. The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.